The next and final section of our first chapter explains the different types of participants within a typical market. Most of what we have reviewed has been very traditional, although I have not heard too many people talk about the parties who actually participate in markets. This is an absolutely critical part of the financial markets, as the parties involved within markets are exactly what allows markets to perform how they do. Understanding who is participating within these markets, how are they participating, and why they are participating are crucial for all trading and investing styles. First, I would like to determine the subgroups that a typical financial market involves. This is quite a simple process, as our participants can be separated into two groups, the retail traders and the institutional traders. Retail traders refer to individual traders, such as you and myself, who typically trade with personal capital. Retail traders will often trade with significantly less capital than our other group and only make up about 10% of all trading activity. Institutional traders refers to firms, banks, corporations, and other major institutions who manage large positions of company, client, or business capital. Institutional traders make up the remaining portion of trading activity at roughly 90%. I want to put major emphasis on the amount of control that these groups hold. Retail, you and I, control roughly 10% of price movement within a given market, while institutions control about 90%. Let's take a look at this candlestick chart of some price action. I have emphasized the current move upwards, which we can quantify as about $10 of movement. We can speculate that roughly 10% of this move was in control of retail traders, while 90% was in control of institutions. This tells us something very interesting about technical related concepts and any retail-oriented trading strategy. Since the retailers can only control about 10% of any given set of price action, we have extremely limited control on price action itself, even with a combination of our efforts. There are three key concepts that we can observe here based on this statistic. 1. We should not follow retail-based strategies. Without going into too much detail on different trading strategies, that I will leave for the second chapter, retail-based strategies can be defined as any trading strategy that derives most of its analysis on what retailers are doing. A common strategy used among retailers is the breakout play, which occurs when price breaks out of a consolidation area or breaks past an area of support or resistance. This strategy may also be referred to as support and resistance trading. While these tactics may be appealing to the regular retail trader, they are very unfavorable to big institutions. Institutions focus on longer-term moves and use larger position sizes, which cannot be placed immediately. It is primarily the institution's entries and exits of their large positions that affect price action, not retail traders. This means that a simple retail strategy, such as the breakout play, may lack a great amount of momentum merely based on the fact that institutions don't use the same strategies. Rather, retail traders, such as you and I, should think like an institution. While I am not going to go into great detail on different institutional strategies, some factors do include volume, order flow, and advanced price action. More on this in Chapter 2, Financial Systems. The second concept that we can derive from the understanding of market participants is that price action is susceptible to manipulation. When looking in the eyes of a major institution, we can see that retail traders are similar to an outlet for liquidity. Think of it this way. Since most retail traders follow the same traditional patterns and concepts, institutions can use this to their advantage. Let's say that in this example, we see an upside breakout from a resistance level as seen in the chart. An institution, which may want to exit a portion of their position, will look for an area where a lot of individual traders are buying. A great place for institutions to find this liquidity is at breakouts, such as the graph that is shown. Since there is a significant change in aggression between buyers and sellers in this area, institutions may take their chance and take advantage of the liquidity. This may look something like this. Now, this is otherwise known as a bull trap, indicating that the bullishness of price is actually a trap and will experience a reversal. something you may ask yourself, is how do you determine when a bull trap may occur? The problem with retail strategies is that it sometimes works, but is always susceptible to traps like these. While it can be difficult to determine when these occurrences happen, there are signs which can be found in other institutional-related concepts that we will go over once again in the second chapter. The third and final concept I would like to review, which I have prefaced earlier, is to follow or think like institutions. As I have mentioned, there are clear differences between retail strategies and institutional strategies. While retail traders may focus on more technical forms of analysis, such as chart pattern breakouts or short-term price movements, institutions focus on longer-term price action, liquidity grabs, and generally place stronger emphasis on order flow and volume. As you can imagine, institutional strategies are much more advanced than your typical concepts in trading, but will be of major emphasis among the following chapters. I also want to point out that strategy is only one ingredient for success, and in some cases is not even foundational for success. Something I have learned over my years of learning is that trading rewards mental toughness and disciplines those who lack such strength. Make note that mental toughness is not defined as being able to get through things and push forward no matter the situation. Mental toughness is resilience, acceptance, adaptability, patience, discipline, and maturity. If there is anything that you need in this business, it is a mindset. This is what you are ultimately working towards, whether you understand it or not, and this is what I will begin to focus on in the future chapters. It is obvious to myself that I have opened a major can of worms here, so I will cut myself off now and save this topic for later.